Hey, this is Geoff Gannon, and you're listening to the Focus Compounding Podcast. This is the podcast where Andrew and I talk general investing concepts. If you want to know more about specific stocks I like, go to focuscompounding.com, where you can read stock ideas written up by me and other members. Membership costs $60 a month, but if you use the promo code podcast, it'll be $50 a month for you. Andrew and I also manage accounts for investors. To learn more about our managed accounts, email Andrew at info@focuscompounding.com. or text or call Andrew at 469-207-5844. That's 469-207-5844. And now here's Andrew with your regularly scheduled podcast.
Alrighty, happy Thursday. How are you doing? My name is Andrew Kuhn. Thank you so much for tuning in with us here today. Mr. Geoff Gannon, how's it going over there?
It's going great, Andrew. How's it going with you?
It is going great with me. We hope everybody has had a great week. Thank you so much for tuning in. Also want to say thank you so much to the rating reviews that everyone's been giving us. Mm-hmm. I've been pounding the table asking, and I really appreciate everybody for doing that. That definitely helps us out here. Helps keep the lights on, as they say.
Because we charge so much for the podcast.
Because we charge so much. If you're listening to us on iTunes and you have Spotify, you want to listen to us there, we're on Spotify now. Mm-hmm. Took us only about a year, but like I said, better late than never, right? Mm-hmm. So Spotify and iTunes, and we announced last podcast we're also going to be on YouTube.
We will, yeah.
And that username is Focused Compounding. There's podcasts that are on there. I got to upload the rest, but we are going to do some sort of video content. I haven't exactly found out or figured out exactly what yet. Like I said, we may do how-to videos or different things on investing, but you can be expecting some content there going forward.
Yeah, so they can go to Focused Compounding on YouTube and subscribe.
Yep, that's right. Yeah. So today we're going to be going over some more questions that people have asked of us. Like I said, it's a pretty good content creator for us, and we get to answer what a lot of people have on their minds. Mm-hmm. And the first question it says, is there a place in an investor's portfolio for lower returning investments that you have a high degree of confidence in receiving that return with low risk? And he says, for example, Berkshire Hathaway and Disney. Mm-hmm. Let's say you expect those investments to return 8% per year, but there's like a 90% probability of that occurring while your standard investment goal is 10% annualized. Is there a place for that in the portfolio?
There might be if you can lower your goal, or if you can't find anything else that has those sorts of returns and you think that's going to continue to be the case. For me, that's not the way that I look at it, because I'm worried always about buying into a too expensive market, basically. Mm-hmm. I feel that most times when people say, well, this is all the returns that you're going to get, from now on, you have to adjust down to thinking in terms of, that you're only going to make 7% a year or whatever from these things, that there's never going to be an opportunity to buy other stocks that have, double-digit type returns. It turns out that eventually stock prices come down, and then you can do that. People said that a lot right before the financial crisis. A lot. If you read a lot of things that I wrote and what people talked about in 2006, 2007, it's a lot of that stuff is, no one's expecting any sort of crash or anything, but they're expecting low returns for a long time into the future. And that's not what happened. Instead, you had a crash and then you had high returns for 10 years, I think that you have to be realistic about your targets that you have that way. I think it's the same thing with like a pension fund. And you're saying, 8% is a low sort of discount rate, is a low rate to expect long term from something. I'm not sure that it is right now, and I think you might have to lower your expectations to that level, certainly. Yeah.
Mm-hmm. And you've talked about in the past, actually, where if you didn't have another idea for a stock, and you did this sort of in your earlier days, you just put in like the S&P 500, and then you just sort of backdoored it out as you found out different ideas. So I guess it's teenager, that's what I did. Yep. It's technically still invested and not just sitting there, probably hopefully better than cash. I don't know.
Yeah, and I think we said putting in Berkshire or something would make sense that way.
Yeah, that's the way I would.
If you want to save money, that just consistently be saving money. You don't want for some people, it may not be a good idea to be out of the market in any way, to be holding cash. That's maybe a bad habit to have long term. Mm-hmm. So I could see that. Yeah, I could definitely see that.
Yeah. Okay. And then he kind of gives a follow-up to that. He says, should you only ever invest in companies where their expected long-term rate of return is higher than your required discount rate? In other words, is there a situation where that is justified, either to gain additional diversification or because you lack investment prospects that exceed your required discount rate?
So I would say no, basically. I think you have to be realistic, and you either have to drop your discount rate. So what we're talking about with the discount rate is, a hurdle rate that you have where you say it has that for me to invest in something, it has to be 10% a year or something as the return. And if I don't do that, then I keep the money in cash, basically. And I think the answer to that is you either have to accept that you have to change your discount rate if you can't find anything, or you have to hold cash. Those are your only two options that way. For me personally, I don't adjust the discount rate down. So we hold some cash in the managed accounts, and that's always been what I've done. Sort of as a rule, I don't want to invest in things that I don't see a path to 10% a year while I hold it, even if I have to hold it for a long time.
So is 10% typically your discount rate that you use? Okay.
Yeah. So that doesn't mean that I'm targeting 10% returns. Mm-hmm. It just means that no matter how much I like a stock, if I can't figure out how this is going to make me 10% a year, and when I say that, I mean holding it long term or something, not we can always imagine that it'll go up 10%, this year because other people discover it or whatever.
Yeah.
There's always that. What I mean is realistically, if you're going to hold this thing 5 years or more, can you see 10% type returns in it? And if you don't, then you don't buy it. That's always what I've done. To try to be disciplined about it. The reason for that for me is that I think it's very easy to miscalculate in terms of what you think something will return. And it's very easy to overpay for something by convincing yourself that, it'll, return 7% a year or whatever when you're looking at like a nifty 50 type stock or something. And in reality, the PE ratio will collapse in half or something. You could have a large loss in the stock, things like that. Maybe if you held it forever and you're right about the stock, it'll work out. But in general, I would do that because otherwise you can start justifying very, very high PE ratios. And there are a lot of stocks with very, very high PE ratios now that are good businesses, but you shouldn't buy them.
Do you think Buffett back in the day, what did he say that people should use for the discount rate? Wasn't it the 10-year bond or something like that?
Yeah, but pay attention.
Rates were totally different back then, right?
Yeah, but pay attention to what Buffett does.
Yeah.
He's never paid a high price for anything, basically.
Sure.
He talks about
it's like the
paying
famous
up
quote,
for things.
Yeah, don't pay attention to what he says. Pay attention to what he does.
And what's he doing now? Holding lots and lots of cash.
Yeah.
So, he will pay up. What he means is he will pay up a lot for the Washington Post instead of Dempster Mill, which he got at 2/3 of net current asset value. Mm-hmm. Instead, he bought Washington Post at, premium to book value or whatever, but a big discount to what people would buy and sell the stock for in, private transactions, what they would buy the entire company for. I can't think of situations where he's paid really high prices for a stock, what we would consider high prices, or things that would seem to have a very low discount rate, to have a very low predicted rate of return. He's certainly been wrong about some things that happens, but I don't think that he's gone into things expecting a really low return that way. Yeah. Now, there are exceptions. I think he may, in some cases where they're using some form of borrowed money and things like that in a regulated utility. So they've spent some money on the regulated utilities where that's definitely the case. And I wouldn't disagree with that, but I don't think that's really what the question's usually about. If you really had a regulated utility, if you really had an almost guaranteed return, because regulated utility, it's not just that it's protected from competition and stuff, it's that it's actually based on the expected return. The regulators are actually making the pricing situation have to do with the allowable return on the assets. So maybe there's a way if you looked at toll roads or utilities or something like that. But even then, if you're not using borrowed money, I don't suggest you use borrowed money in a brokerage account, then over time you're going to underperform. Mm-hmm. I mean, it's sort of like saying, is there ever a place for corporate bonds or something? I think for high quality corporate bonds, there isn't, because in the very long run, you will underperform in high quality corporate bonds than you will by picking your own stocks and holding them. The stocks will have higher returns. So I don't think people should generally own government bonds. I don't think they should own corporate bonds unless there's special situations where you have a high possible rate of return in them. Now, you can own them basically as a cash, alternative. Sure, obviously, you can own something that's going to, some government obligation that's going to mature in 30 days. That's basically cash, and that's something different that we're talking about. But no, I would never buy into things that you feel they have a guaranteed rate of return at much lower percentages, because in the long run, that just leads to worse compounding for you.
Underperformance, yeah.
Yeah, well, it just leads to a worse outcome for you personally, the goals that you have in your life and stuff. If they're long-term goals that you have, you have a much better chance of reaching them if you're invested in assets that compound at higher rates. So you can convince me that it should be commercial real estate or farmland or something instead of stocks, but you can't convince me that it should be government bonds that have never been a competitive asset class when compared to stocks. Over when we're talking 30 years or something, yeah, they compete over 5 or 10 years, but that's speculative, and that's just seeing, short term what you could get. What matters is the long term compounding, and businesses are going to outperform other forms of assets that you could have.
Cool. Next question. We haven't had any questions on banks in a long time.
Yeah, that's true.
And he says, how does Geoff think about the valuation of regional and community banks going forward with the possibility of lower rates and worsening credit conditions? Is this a moment where value investors are being suckered into cyclical industries by low PEs?
No, I'm not worried at all about that. Now, I should say I don't know much about community banks, but I can talk about regional banks. So we wrote up about probably 5 regional banks for Singular Diligence, which is a newsletter that I did a few years back. So this would mostly be in the 2013, 2016 period. And we talked about Prosperity Bank shares in Texas, Frost in Texas, Bank of Hawaii in Hawaii, and then BOK Financial, which is tickers BOKF, which is Oklahoma, also Texas and some other states. And I think we did one other bank, which is St. Louis area. So those are all essentially regional banks, with a couple of them being focused on companies serving fairly large companies in the area. Specifically, Frost in Texas is, the good aspects of the business I like are mostly serving pretty big Texas businesses. So it's a bit of a business bank that way. I don't think that those stocks are expensive.
Why? Because of rates?
Yeah, well, I don't think they're expensive when compared to other companies right now. I would say the same. I mean, are they going to grow in the next couple of years? Well, in some cases they will. So like in the case of Frost, yes, they will, because there's going to be they're just going to get higher yields on their loans over time, because Frost is probably lending on average, 5 years when they make the loan. On average, the loans will have been made not this year, so it's actually going to be shorter, the average that they have there. But you will still have some effect from rate increases that you had before. It wasn't that long ago that rates were being increased. So until you go 3 to 5 years after rates are being increased, you're not going to have the full effect of all the rate increases in terms of the loans that you have. So you have that. And then you have the PE ratios on them. And the PE ratios aren't high. And the PE ratios on other stocks are very high. I mean, it's hard when looking at things like, for instance, I can see a future next few years where a lot of those banks don't grow much at all. I can also see a future where a lot of ad agencies don't grow at all. The difficulty is coming up with a way in which stocks that have much higher P ratios outperform these things, and in some cases we're talking about are 10 to 15 times P's. There's some pretty low P's on some of these regional banks. You see the same things with ad agencies, very low P's. They're all clustered in that same group. So I can totally buy the argument that they're not going to grow. The problem is, even if they just buy back their stock, even if they just pay dividends, they're very likely not to underperform tech and things like that, which people might be a lot more interested in right now. So I'm not worried about regional banks. I'm also not worried about the kinds of loans they've made recently. There are exceptions to all of this. There are banks I could name that I would be worried about the kinds of loans they've made. But in general, I just feel like they're in a much safer place than they were, at the time of the financial crisis or something like that. I mean, if we were to have a recession, even a pretty meaningful recession, I don't think it would register, like saying the results of Frost in a big way compared to the recessions that you had in the early 90s and the 2008 financial crisis. For banks, the early 90s and the 2008 one were much worse than I would expect any sort of recession now to be, not because the economy couldn't do badly, but just because the banks aren't nearly in as bad a situation. The amount of loan growth and stuff was not high during this boom that we've been having. That's not what was happening. So it's very different than we've had at other times that way. So in overall, no, I'm not very concerned about it. And the banks that I like best, that I feel are fairly safe banks, like Frost Bank.
I remember Frost. I don't even think Frost has moved that much over the past year.
The stock?
Yeah.
Yeah, that's probably true. I don't think that they're overpriced at all, those stocks. Yeah. Especially compared to other stocks that are out there.
Is that where you'd be looking if you were managing, if your sort of stipulation wasn't just focused on smaller overlooked stocks, or not smaller overlooked, but just overlooked stocks in general?
If I had to manage billions of dollars, yeah. Definitely if I had to manage billions of dollars. If I was managing over $1 billion, or at least several $1 billion, I would definitely look at some regional banks. I'm going to name specifically Frost and Bank of Hawaii as standing out that way. Although there are others, and we wrote up plenty of them. Mm-hmm. As far as like really small banks might be a different story. I don't necessarily think that really small banks have a lot of advantages, and I think they have less and less advantages going forward because of certain technology things and stuff with scale. But like regional banks, when we're talking about one of the biggest banks in the state of Texas, one of the biggest banks in the state of Hawaii, things like that, yeah, I actually like those banks quite a lot. Mm-hmm. And that doesn't mean I don't like JP Morgan and Bank of America either. Yeah. But no, I think that right now banks is not a bad place to be. And compared to other stocks, it's definitely not an industry that will worry me.
Cool. Hopefully that answers this question. And then the last question, a few podcasts ago, we talked about stock.
Okay.
And he said, on a recent show, Geoff talked about Majestic Wines. Mm-hmm. What specifically doesn't he like about the company?
Oh, well, this is a problem because the company announced something that's going to sound really bad when I tell you what I didn't like. So there's a company called Majestic Wines, which did originally larger volume sales. So you had to buy like like 6 bottles of wine or 12 bottles of wine originally. But it was basically just a brick and mortar retailer of slightly higher volumes of wine. Although their stores were very small by American standards, they were pretty big by British standards and doing a pretty big volume of sales of wine for a company that focused just on wine. In the U.S., we have a bunch of companies that sell, for instance, right where we are, there's like Total Wine stuff, which sells every wine imaginable and is one of the biggest stores you've ever been in. And, they don't,
like a warehouse.
They don't tend to have wine warehouses in the UK. And what they did have is Majestic Wine, and it was the closest thing I would say to a UK wine warehouse. It was brick and mortar, and it had some problems because of that, obviously, and also other things, selling wine in supermarkets and things like that, competing with them. But there was this entrepreneur who had once been part of Richard Branson's Virgin Group, right? And had done some things there, started up a business there, been involved in the wine business, and had this concept, Naked Wines. And so anyway, he ends up being fired or quitting or whatever from the Virgin stuff, and does Naked Wines, which is online wine sales. And the idea being that people pre-order, they have demand for it, they know that there's an audience for it, and so they work with contracting with vineyards and stuff to have the wine produced for them and then sell it. By the way, Total Wine, probably 20 or 30% of the stuff in their store works that exact same way. Mm-hmm. It's like, this is exclusive to Total Wine or whatever. That's because they're buying so many cases that they agree to do. So the same concept, but online. Everyone gets really excited about that. I read about the CEO and some things like that and was not enamored with him. And from reading other people's blog posts and posts in forums and things like that, I can tell that other people are really excited by him. Mm-hmm. And I'm intentionally not saying his name because I'm saying a lot of negative things about him. I was not, the way he communicated and things like that. I thought he was a great salesman, great promoter, probably a very exciting person to have, if you're got a startup or something. I did not want him to be the CEO, chairman, etc. of the company. I didn't want him to be in charge of its future direction, and I was worried about that. As it turned out, Majestic Wine acquired that business. It then made him the head of the overall combined company. Mm-hmm. And then very recently it decided it's going to sell off or get rid of in some way all of the brick and mortar business.
So it's like they're going online. Yeah.
Right. But
they're taking a
this is Naked Wine. It's going to be Naked Wine.
Yeah, they're taking
that's all. Wine. But I mean, that's all that's going to be left now. Uh-huh. And that's the part that I was least sure of. And more than being least sure of the business of Naked Wine, I was not sure of the management.
And then from that, you shied away. Is it a bigger company?
No, Naked Wine was smaller. Mm-hmm. But faster growing. Mm-hmm. Yeah, it's grown quite a bit.
So you don't like
the CEO.
And
it wasn't very profitable that way.
And so you don't like the CEO and kind of where they're going with it, so that's why you shied away. Why do people like it? Do they look at it like, oh, this is just a lower cost way to do it, or what?
Yeah, it could be the future. Mm-hmm. It could be a great way to do it, sure. Yeah, I don't think that's not. I mean, when we did the report and stuff, we certainly looked at the possibilities of competition from online, just like we did when we did a report on PetSmart, and competition from online pet food in that case, and lots of things about the possibility that could happen with online wine sales. And it is a big problem in the UK compared to the US because the efficiency of the stores it's not like what we're talking about with Total Wine. I mean, to put that in perspective, there are there are companies in the US that are only in a few locations in certain states and stuff. They're not big companies at all that operate much bigger stores than anything I know about in the UK. So the retail offline is not as incredibly efficient. And so it's much more at risk of competition from online there, definitely. Whereas like with the example of like online pet food stuff, which is sold a lot in the US now, but it's sold by something that PetSmart owns. But it was hard to compete with it in the US compared to Europe because PetSmart was a much stronger, much more efficiently run store, whereas you didn't have stores of that scale and efficiency just in keeping costs down and stuff in some other countries. And so it was much easier for them to have online pet food competition. Same thing in the UK. I think it's much easier for them to face tough competition in some of their retail stuff, the category killer stuff, which is what the wine things we're talking about are. So yeah, the basic thing is, we talk about when assessing management things like candor and my ability to predict what they're going to do and some other things like that, which aren't really measures of how smart they are or how skilled they are in doing certain things and how capable they are. And there was nothing about the now CEO of Majestic, which I guess will be Naked Wine. Nothing about him that made me feel that the business plan wasn't a good one or that he wasn't capable of carrying it out. I just was not sure that I would be confident getting communications and stuff from this person while owning the stock. I didn't feel I knew it well enough. I felt it was speculative. In no way do I think it's a bad stock. I just think it's a stock I'm much less sure of with him in control and with the focus that they now have of being online wine stuff. But I guess a lot of people would agree with that. It's less tested and stuff. This is it's the future that that excites them. It's not that they're so sure of what the outcome will be, I guess. And maybe this is the complete right way for the business to go. I'm just much less confident than when I was analyzing the old Majestic wine with a different management and a different strategy. So I just know so much less about this and know so much less about the people involved. I don't have as good a handle on it. So, and there's so many companies where that would be true. I don't talk publicly about it, but there's lots of companies where I've read things and gone, no, I'll pass on.
You just didn't feel comfortable with it, yeah.
And sometimes because of who's in charge. I haven't said before, but I don't mind saying because it's a big company. I looked really hard at Western Union a long time ago and would have done a write-up of it for Singular Diligence and made it a pretty high up there thing, but did not like the CEO. And not that I didn't like the CEO's abilities or anything like that, did not like the way the CEO communicated about things. And so
was just like very vague or what?
Yeah. Didn't take responsibility for certain things that they should have. And tried to guide expectations about what investors should expect that I think were shaping the narrative of what to say the company was doing and stuff like that. It's not uncommon at all for companies to do that. But when combined with a business that you need to be able to see certain things about what's going on, it can be misleading in terms of understanding the basic things that are happening with customers and stuff like that, And I would say, yeah, a lot of times they would do that. When they would talk, for instance, Western Union uses the term pricing investment to mean that they've cut the price of their fees, which they do all the time. Western Union strategy forever had been you lower the fees, you get more volume, you lower the fees, you get more volume. And across a payment processing network that they have, you make more and more money by doing that while your average fee always goes down and stuff like that. But they were not... I felt doing a good job of explaining why they were doing that because of customer behavior in certain places, sending from one country to another. In certain places like US or Mexico or something, I think they cut it for very good reasons that they knew about customer behavior on those things. And they didn't really talk openly about that. And I felt it makes it opaque. And there are aspects of Majestic Wine with the management that they have now where I feel the same way. Not that I feel things will go badly, but I think that if things are going badly inside the company, it will be harder to know that because they'll put a spin on it when they talk to investors. That will make it a little more opaque in terms of what is really going on. They'll tell you a lot about their plans and what they're going to do and all their ways of fixing things, but they won't really tell you what the problems are that they need to fix, And that might be unfair. I don't know that much about him. I didn't read that many articles and interviews and things like that before. But
that was just the general impression you got.
Yeah, but it was enough that we didn't do Majestic Wine because of it.
Mm-hmm.
Yeah.
And that's okay.
Yeah. So there have been others where I passed just because of the people involved. And it has nothing to do with concerns about any sort of, all these things that people worry about accounting things and whatever things. It's nothing like that. It really is just, I don't feel, like compared to the stocks that we have in the managed accounts, okay? These are the candor that management has when talking about things in the annual letter and stuff is just not going to be the same.
Sure.
However, I do think he's an excellent salesman of the concept and a salesman of himself and a very smart person.
There you go. We could leave it on a good note.
Yeah.
We'll leave it on a good note. Thank you so much to everybody for tuning in with us here today. If you do like what we're doing, feel free to give us a rating and review. If you also want to be added to Geoff's weekly memo list, focuscompounding.com, you'll see a spot to enter in your email. If you want to reach out to him, gannoninvesting@gmail.com, me, info@focusedcompounding.com, or you could just follow me on Twitter @focusedcompound, where you can send me questions and we will pull them and talk about them on the show. Thank you so much for everybody for tuning in with us. Make it a good week. We'll see you in the next one.
Hey, this is Geoff Gannon, and that was the Focus Compounding Podcast, the podcast where Andrew and I talk general investing concepts. If you want to know more about specific stocks I like, go to focuscompounding.com, where you can read stock ideas written up by me and other members. Membership costs $60 a month, but if you use the promo code podcast, it'll be $50 a month for you. Andrew and I also manage accounts for investors. To learn more about our managed accounts, email Andrew at info@focuscompounding.com or text or call Andrew at 469-207-5844. That's 469-207-5844. Thanks for listening.